Well, Bryce, before we speak to Oscar, let's unpack Viva Energy. Tell us about the company.
Viva Energy is an Australian energy company. It's in the name, just like corporate travel. No, it's an Australian energy company that operates in it has sort of three distinct businesses within it. So it's got energy and infrastructure. It owns the Geelong oil refinery. I think that's one of two refineries left in Australia. It operates in the commercial and industrial fuel space. So the B2B part of the business, fuel and energy for things like planes, ships, agriculture, real industrial part of the business. And then thirdly is the convenience and mobility. That's what the company calls it. But in other words, that's their retail, petrol stations, and operation of the retail stores across Australia. Shell retail stores across, and Coles, I should say. Three main elements to the business.
Yeah. Now, to give you a bit of context and a bit of history, Viva was essentially spun out, or it was bought out of Shell's business in Australia. And so, that's why they were involved in Shell service stations. So that was in 2014. Then Viva was floated on the ASX in 2018. And my experience with Viva, so when I was at Coles, that it was Coles would run the service station shop, and then Viva would supply the petrol. They were in charge of the forecourt.
Yep.
And it was really like, this is what you're responsible for, this is what we're responsible for. And I just remember, because I didn't work in Coles Express, so I'm not speaking out of school here. This is all sort of just what you'd learn from being in the same building and reading the news. But Coles, it was such a pain point for Coles that their petrol was always more expensive than competitors. And it was always more expensive because Viva weren't making any money from the shop. They were only making money from the fuel. So whereas competitors could price their fuel at cost and then make money from the shop, Viva, if they were going to make money from this business, had to make it from the fuel. And so I just remember there was always negotiations around fuel prices and this and that. And it was just like, it was a bad business structure.
Yeah.
And that's my view looking from the outside. Yeah. And since then, Viva have now bought the Coles Express business. And I think they're in the process of rebranding them. They've also bought a South Australian business on the run, which I'd never heard of, but I asked Alf, and he said, so Alf is from Adelaide, and he was like, I know it.
Interesting.
Didn't give me much more than that, but he confirmed its existence.
So they have On the Run in South Australia, and they've got about 710 Shell sites operated by Coles Express, well, now operated by Viva Energy, across the country. And it makes sense that they're going to roll this up into one single brand across the country. It's a pretty significant network size when you look at it compared to their competitors. It's actually the largest in terms of fuel and convenience. As I said, 710 stores. Then Ampol comes in second, and then the 7-Eleven network is third. On the Run is the 9th largest, but if you combine On the Run and Shell together, they're going to be close to 1,000 stores across the network.
Yeah, it's pretty interesting. Small format retail in Australia, it's not as exciting as it is overseas, I think.
It's massive overseas.
Yeah,
UK, Japan,
we spoke to
Asia.
Are you just naming different parts of the world?
South America.
Recently, we spoke to Ashish Swarup before he pitched at the HM1 conference. He spoke about Uni President Enterprises Corporation, a funny company name, like how generic corporate could you be? Uni President Enterprises Corporation. But they are a small format retailer out of Taiwan and across parts of Asia now. And, he was talking about how good they are at small format retailing. When we went to Japan, like, you're just blown away by the Lawsons and the 7-Elevens.
Unbelievable.
We've spoken to another expert who spoke about Alimentation Coutard.
In Canada.
I butchered that. French Canada now, but like 14,000 stores. Apparently they're great small format retailers. No one does it well in Australia.
No.
Well, maybe On the Run do.
We're about to find out.
Well, we're about to hear.
Well, I mean, find out when they come to New South Wales.
True.
Because I tell you one thing, for me, it's just still too snacky whenever I go into those places. I think that for me, the difference between thinking about Lawson's is you could actually get decent meals in there.
Yeah, I mean, you are obsessed with the idea of a deep fry being next to the counter.
Yeah, well, who doesn't want that?
Anyway, let's go back to Viva Energy. So, essentially, the original business was the oil refining business. The second business is B2B, selling that refined oil to industrial customers, airlines and the like. And then the third business is the small format retail business. It's an unloved part of the market, the oil company. Obviously, I feel like 2021 and before then, there was a real ESG movement. 2022 saw a bit of an anti-ESG shift, and a lot of the oil companies did quite well. But yeah, Viva wouldn't be in a particularly loved part of the market, I would say.
From an ESG perspective?
And just like from an ESG point of view, but also just like it's not seen as a very future-facing industry.
Yeah.
Let's put it that way.
Yeah.
No one thinks there's big structural tailwinds driving oil for the next few decades.
Yeah.
Although, like, we're always going to need it. As much as people might not want to hear that. It's just how much we need. And then oil refining in Australia is kind of like aluminium smelting and steel making. We're a high labour cost, high energy cost country. And so a lot of these heavy industrial businesses struggle. So that also makes it unloved. And then retail's brutal.
Retail's brutal, but they're putting a lot of focus on it.
Well, I guess my point with all that is this certainly feels like an unloved company.
It does, but I'm looking forward to hearing Oscar's take on Viva, because he's obviously going to be pretty bullish on it, I would imagine. Yeah.
Well, and then I think the final element why it's unloved is its swings between being profitable and being unprofitable, and its earnings are quite volatile. So add that all together, and Oscar's got a tough brief.
I have a soft spot for retail.
You for a while you were trying to call yourself the retail whisperer.
No, you were calling me the retail whisperer.
For a while on the show, you were getting named the retail whisperer.
Yes, but look, I'm looking forward to speaking to Oscar about, to your point, Ren, feels like it could be an unloved company, but where does the future lie for a company that is facing, probably not as many structural tailwinds as some of the other companies that we're talking about in the summer series.
Yeah. I don't think it could be an unloved company. I think it is an unloved company. The question is, should it be?
Well, let's get Oscar in to find out. Well, it's a pleasure to welcome Oscar Oberg to the studio. Oscar, welcome to Equity Mates.
Thanks, guys. Appreciate you having me.
So to kick off, can you tell us what do Viva Energy do?
Yeah, sure. So Viva Energy is quite a large company, listed on the ASX, I think back in 2017. And effectively, it's got three divisions. So the first division is the retail division. Think of that as Coles Express or Shell service stations across Australia. There's just over 700 of them. They've got a commercial division. This division supplies fuel to, say, the aviation industry or the cruise industry or the agricultural mining industry. So obviously outside of retail, call it B2B or business to business. And then you have the refining business. So refining is a very cyclical industry. And think of that as Viva Energy receives a lot of the oil that's pumped out of the ground or crude, and then they convert it at their Geelong refinery, which is this huge facility down in Geelong. And that will then ship off for their own needs or for other, call it petroleum companies. So I think that refinery is... refines 25% of Australia's crude oil that comes in every day. So it's very, very important to Australia. So that's probably the three divisions: retail, commercial, and refining.
Yeah, right.
Nice. And in terms of the respective sizes of the divisions, give us a sense of how big they are in the context of the company.
Yeah, so that's I mean, this is why I'm here today, because it's an interesting one, this business, because refining is a highly, highly cyclical industry. I think it was through COVID. when no one was driving cars and all the planes were down and no one was flying. That business lost over $100 million of earnings last year because effectively all started up again and a number of refineries closed through that COVID period. It did well in excess of $500 million of earnings. So that business varies year to year. But, if we were to assume, call it a mid-cycle level of earnings, at this juncture, that business should do around, call it 30 to 35% of earnings. And then the remainder is split pretty evenly between retail and commercial.
Yeah, okay. So we're going to talk about, I guess, the bull case, how you build a thesis, and then the bear case, some of the risks that you're thinking about when you're looking at a company like Viva. Before we get to there, let's just talk about how you analyze it. So you come to this company, it's got a retailing arm, B2B arm, and a refining arm. What are the metrics that you're looking at to assess whether it's an interesting company or not? How are you going about analyzing it?
So in terms of at Wilson Asset Management, where I work, we're always looking for undervalued growth companies, and we want a catalyst. And that for us is always the most important thing when we're buying a company. And that catalyst actually came in 2021 for Viva Energy. And what happened was with the refining business, as I said before, it's very cyclical and it lost a lot of money in 2020. And at that point in time, I think there were 4 refineries in Australia, and 2 of them said, enough's enough, we're going to close. And sure enough, they did, leaving obviously the Geelong refinery and one other. But the government at that point in time was like, hang on here, what about our security of fuel in this country? Like, if we have another COVID event, we've lost 2 refineries, we've only got 2 in the country. Appreciate it's a very hard industry. It probably shouldn't be done in Australia because of how high costs are, but we need to secure our supply of crude oil. And so what the government did was they created what's called a floor, or basically think of it almost like an insurance payment to the refiners such as Viva Energy. So what this payment means is that effectively the lowest amount of earnings that these refiners can make is or Viva Energy is $100 million. So that's the lowest it can go now. It won't make a loss of say 200, 300. It will actually make a profit of 100.
Wow.
And that is the catalyst for us, because now we see that the downside to this business is now capped. So that was the initial catalyst for us.
It's crazy that the government don't say, we'll get you back to break even.
0, yeah.
Yeah. It's crazy that the insurance gets you to 100 million in profit.
Well, it sounds a lot, but these are very capital intensive industries, and they're very you need a whole heap of capital of expenditure every year to keep it going.
True. Yeah.
And so even at 100, it sounds a lot, but they're probably not even making their cost of capital at that point. So all it is effectively preventing these businesses from losing money, which is a good thing because the government effectively needs security of supply of fuel in Australia.
It's a good thing for investors as well.
Well, it's a great thing for investors, which I don't think the market has fully appreciated yet, because what happened, and this is typical in investing, isn't it? The government came in and said, we're going to give you this payment. This is great. And then after that point, refining margins went up a huge amount, and Viva did over $500 million of earnings in that division last year. So it will take it for refining margins to fall a long way for the market then to see, well, the worst the business can do is $100 million. And at least that's my backside. That's my backstop.
Have you seen that then flow into how they invest back into the other, B2B and retail? Like if they have this safety net of guys, we're going to be making $100 million here. Has that changed how they operate the other 2?
So I think they've had a massive windfall over the last 12 to 18 months. And a lot of this is getting used for the long-term strategy, which I'll talk about in a second. But there is no doubt now in the back of their minds, if you can have a profit of 100 versus a loss of 100, that's a $200 million turnaround. That's huge for your cash flow and your ability to forecast, what you're going to spend in the future. So there's no doubt that would have a benefit to them in the back of their mind.
Well, sorry.
Just randomly, but if Ren and I were to start a refinery, would we get that government benefit, or is it for existing refineries?
Good question. I think it would cost a bomb
to
start your own refinery. So good luck with that. I don't know how you do it. But
does Wilson want to come in on it?
No, I don't know. It's a pretty tough industry. I mean, to replace it, I've been to the Geelong refinery. It's enormous. It's enormous. And I remember when I went down there, it was losing $150 million or something that year. And you're looking at it, go, whoa, how does this thing lose that amount of money? It's so impressive. But yeah, Who knows?
Yeah.
I don't really know. The answer.
I mean, the answer is is high energy costs and high labor costs.
Yeah.
That's how they lose 150 million.
Exactly.
We want to get to the longer term strategy.
Yep.
One more question on the guarantee before then, or the insurance policy. Is it permanent or is it a COVID era policy? Is that like, does the market think maybe there's risk that it comes off at some point?
So it's guaranteed, I think, to 2028.
Okay.
But I think the fact that you've had 2 refineries leave, the Australian market since that point probably tells you that it's very important for the government. So whether it gets changed in some way or not in the future, who knows? But again, $100 million of earnings sounds a lot, but as it falls to the bottom line, it's if you look at the profit line after all depreciation, interest, etc., it'd be break even at best. So, So I think what's more important probably for the government is preventing. If there's a COVID situation again, like we don't want to run out of
or a national security situation where we're a little island in the corner of the map, cut off from the rest of the world.
I think refine. Think about the Russia-Ukraine war and what's happened in Europe. I think that's what you think about when you, in terms of what they've done there. Yeah.
So that's the downside we've spoken a little bit about, but we're not here to talk about the downside. We're here to talk about the upside. So let's talk about the bull case.
Yep.
What is Viva Energy doing that is really interesting to you? And your long-term investors at Wilson, we like to think long-term here at Equity Mates. So how are they building long-term sustainable competitive advantage?
Yep. So I think when people think about Viva Energy in the broader Australian share market, they think about the refining division, which is what I just talked about before. And as I said, now the downside's capped in that division. They've had a windfall over the last year or two, so they've got excess cash on the balance sheet. And what they've done with that is they've done 2 things. So when you see a Coles Express service station, in the past, Viva Energy used to run the fuel, and actually Coles used to run the shop. And so Viva made all their money from the fuel, but they didn't make any money from the shop. And so basically, about 12 months ago, Viva bought, I guess, the shop from Coles, paid amount of money for that, and now they control everything. And that's across 700 service stations across Australia. But the big thing they've done is about 9 months ago or so, they bought the largest operator of service stations in South Australia called On The Run. Now, you might go, oh, South Australia, it's a small state, who cares sort of thing, you know what I mean? And it is. However,
well, that's your saying. We love our Adelaide and South Australia listeners here.
Yeah, sorry about that. Adelaide shareholders for WAM Capital as well. We love you too. No, but I mean, this business On The Run, I've been lucky enough to go down and see it. And your South Australian listeners will know this business very well. They've effectively changed, call it retailing in I guess, the service station industry. If you go to one of these and you compare it to Coles Express or BP, you'd be like, whoa, like what is this business? And to give you some maths around how well this business does. So the average On The Run service station does approximately, I think, $4 million of sales a year. Your average Coles Express service station does about 1.6.
Wow.
The margins an On The Run service station does about 40% at the gross level before corporate overhead. And Coles Express, I think, does about 32 or 33. So they generate more revenue, they're more profitable, and Viva has now bought it. Now, what Viva's going to do over the next 5 to 7 years or so is they're going to slowly convert their 700 Coles Express service stations across Australia and change them to On The Run.
What are they doing differently?
Great question. So it's funny, you always see things on a bit of paper, and then until you go in there and you sort of get, you see it and you go, oh, I sort of get that. And, I was very skeptical as well. And then I went into one, and we went into a few. We probably went into 10 and spent a whole day doing it. And it's pretty simple. It's just they're retailers. And, Yasser, the guy, the founder of the business, he's had this view with service stations longer term that electric vehicles are, effectively going to disrupt the industry. So he's built his business not on the fuel, but on the shop. It's all about the shop. It's all about convenience. It's all about people coming in, having a great experience and wanting to come again and buy, not just when they're fueled, just in everyday life. And so if you go to the average on the run will have its own franchise. Most service station operators lease that out to someone else. They actually operate it. Yasser himself, I think, worked in a subway in the United States a number of years ago for a long time and understood it and brought it out into Australia as one of the first service stations to do that. So you got the franchise, they earn more money. You got to take more risk, but they earn more money. A large percentage as well of his store is private label, so his own brands, and so you actually get a higher margin on that. They have a barista in most on the runs. So if you think about it, if I go, I'm gonna go to my local service station, it's 5 minutes away, on the app, and I'll come back to the app. On the app, you can order your coffee. Then you go to the servo, coffee's ready, thank you very much. I'll get some lollies at the front, or, whatever. That's a private label. That's not that's a random brand you never heard of. They make good margin off that and then take it off and away you go. The other thing that they do, which I think is huge, is I don't think, maybe correct me if I'm wrong, I don't think I've seen an app for Ampol or Coles Express or anything like that really can do anything, or BP, like within the shop. Well, these guys have their own app. So effectively what you can do is you go to the servo, you put your petrol in the car, and then you can pay at the Bowser. And also when you pay as well, think of it like a poker machine comes out, up, spins, and might say, I have a free water, or I have a free coffee, you get 10% off your petrol, all that sort of stuff. So it gets you coming back. And look, for context, the Coles Express, in terms of the Coles Express service stations that are near and on the run, it's certainly within the Adelaide CBD. I think there's a high percentage of those ones that lose money because these guys have just dominated the industry. So, so clearly, if you do look at the maths behind the rollout, so you think, okay, there's 700 service stations. There's probably a growth pipeline of another, call it 150. With the on the run, just from their current growth profile. So we could be sitting here in, say, 5 or 6 years' time, where the 700 service stations go to 1,000 in Australia. They go from branded from Coles Express to on the run. Each service station is earning sales of $4 million instead of 1.6 at a higher margin. And you plug that into sort of your numbers, and suddenly you've got a retail division that a year ago didn't generate any money from the shop, but when in about 5 years' time, we'll do well over 50%. And in terms of valuation, and that's important for us when we look at companies like this, today Viva Energy is trading on a valuation of 11 times on a price to earnings multiple. I think the market might be 16, 17 times, so it's a discount to the market. It is trading at a dividend yield of about 5 or 6%, so the stock is very cheap. Woolworths is trading, which is a convenience retailer, is currently trading on a price earnings multiple of around 22, 23 times earnings. Now, I'm not saying that it goes to 22, 23, but does it go to 15? And so you've got a period where your earnings, can effectively double for this business in the next 5 years. But not only can the earnings double, but the valuation could also go up 50% as well. So this is why we're very bullish on the stock. We really like it. It's a really good long-term play, and we think the share price can more than double from here.
Wow. Pretty convincing. Nice. So, Oscar,
but it's a good story. They've got to execute.
Just remember they execute. Well, we're both ex-retail, so can certainly understand what you're talking about. Ren's a Coles boy, actually.
Yeah.
I'm a Woolies guy. So
I was saying before we turned the mics on, I wasn't in Coles Express, but we heard about the Coles Express and Viva relationship, and Viva were always known as very tough negotiators. So probably good if you're an investor in that business. So it just reminds me, we've spoken to an expert on the show before about the Canadian retailer. I'm going to butcher the name. Couchard Tart, Alimentation Couchard Tart, who have just
gold standard, aren't they?
Yeah, just nailed the small format convenience retail, and I think they've got like 14,000 stores.
That's
so,
right.
Yeah.
That's what they're trying to do.
Well, I mean, North America is a much bigger market than Australia, but nailing the small format retail is something that Australia hasn't really done. Like you go to Asia and their small format retail is just unbelievable. There's some big players in America that are doing it well. I'm here for Australia to get small format right because it would just make our lives better,
Oh, totally. 100%.
I mean, marginally better, not like a massive change, but it'll be nice.
Absolutely. And that's who they're trying to become. Like I think Couche-Tard trades at I think like 10 or 12 times EBITDA, and Viva's at 5. So it's double the valuation.
Yeah, yeah.
And then, so to close out, I guess the third component before we move to the bear case, is there any part of the thesis that revolves around their B2B, or is that just a nice to have?
Well, the B2B business or the commercial business, if you looked at Viva over the last 5 years, that's been the highest performing business. And it does get lost in the, I think we all take that business for granted, but he's done incredibly well. And management themselves have a target that they put out to market a few weeks ago of getting that business to well over $500 million of earnings in the next 5 years. I think it's currently doing about 350. But they've done incredibly well taking market share. Like as other competitors pulled out of aviation or marine, they actually went stronger when times were tough, and they've taken market share there. So there's that more acquisitions they can do in that space in time. But definitely, if we looked at Viva today, where the majority of the growth is going to come from and the re-rating of the share price or the high valuation is definitely from the retail division.
Yeah, nice.
So let's turn to the bear case. Yep. That you've laid out the thesis. It's certainly compelling. What are the risks to that thesis? And as someone who's holding the stock, what are you watching, and like what would be your sell signal?
It's execution. So, I mean, all those metrics I just talked about then, we need to be making sure that they are achieving that. They're also given guidance around what they're going to spend on capital expenditure to roll these stores out. And, if that blows out and they're not getting the returns that they've said that they would to the market, that's definitely a sell signal. But I think the interesting thing with this, and you guys worked in retail, and all your listeners work in retail, and I always say this to my friends and stuff in the market, you'll know whether it's working or not just by walking into one of them.
Yeah.
You know what I mean?
Yeah.
And there's one in, I think, Lane Cove in Sydney, and they're starting to come out at in a few states. Just walk into one and then compare it to, the Coles Express down the road.
Yeah.
You'll know. And it's and I think with these big acquisitions, and this is probably the biggest risk as well as execution, is Viva is a big company. It is a huge company. It's combining the Viva systems, the Coles systems, and the on-the-run systems. Like that's, when we look at companies when they're doing acquisitions, it's always the systems integration. If that stuff's up, that's usually, when things go bad. So it is a big, big job. Yeah. There's no doubt about it. But we always come back to management. And, for us, when we look at, particularly Javan, who used to be the chief financial officer at Viva, is now the head of retail. We think he's one of the best guys we've met in the market over the years. And Scott, the chief executive, in terms of what he did through COVID and, the minimum support for refining is huge. Like he's been with the business forever. Like they're a great management team, and we've been lucky enough to meet the executives underneath, and they're very high quality as well. So that gives us some comfort. But, as I said, it's a great story to talk about, but it just comes down to execution, and that's what you got to monitor the most.
The South Australian guy, I've forgotten his name, who
Yasser.
Is he staying with the business?
Yes, he is. Yeah.
Oh, that's good. That's reassuring.
And he's young as well. And I think you meet a lot of these managers over the years, and what their passion is. And I feel with Yasser is you've met him a couple of times now. It's almost like world domination. That's what he wants.
Right. Okay.
You know what I mean? He knows that this industry's worked I think he's a lawyer by trade. He came into the industry sort of, they had, I think, one service station in Adelaide, and he wanted to make it work. And then one becomes two becomes 4, 8, etc. And so he's done it from the ground up. So he wants it to work across Australia and change the industry.
Well, one Adelaide person has already achieved world domination with Rupert. So maybe there'll be another one.
There you go.
So, Oscar, to sum up, if all of this plays out as expected, and looking sort of beyond that 5-year time frame that the management have sort of put forward, what do you expect the Viva Energy to look like as a business in 10 years?
Ooh. I'm talking about. See, the thing is with Viva, I'm just talking about the 5 years here, 5 to 6 years with the retail rollout, and if that is successful, as I said, like shares are trading at $3 at the moment, really should be $6 with a re-rating of the share price as well. But the business generates great cash flow. So it's got a huge amount of opportunities with it as well. So, something I haven't talked about today is, for instance, they're thinking, hasn't exactly happened yet, but there's, with a number of partners, they're thinking the excess land that they have at the Geelong refinery, they wanted an import terminal for LNG gas. I mean, that could be something that comes, that'd be substantial, and they could take an infrastructure style return on that. That'd be huge. The government with what they did with the refining and the minimum payment to the refiners, they also have minimum storage obligations, which means that a lot of their competitors, Viva's competitors, are forced to have excess crude stored at Ampol, which is obviously a competitor to Viva, and Viva's refinery. So that could be additional earnings as well to Viva. So, yeah, I mean, like everything I've talked about today takes increases the earnings base by more than double. But the business will look vastly different in 5 years with all this excess cash. And as I said, the business, right, if I'm wrong, right, the business today he's got minimal debt, pays a dividend yield of 6%, and is trading at 11 times earnings. Like it's not priced for perfection. It's not priced for this to occur. So if I'm wrong, I still feel there's decent downside protection for the call, if that makes sense. So given the valuation's very attractive. So I haven't really answered your question, even though I spoke for a long time.
No,
I do
think
think if they've guided to sort of 1.25 billion in 5 years or so, if they execute on that plus the cash they generate, it could be line of sight at that point to 2 billion for all we know, because there's just a lot they can do, and they can take on the run. Why can't they take in Asia as an example?
Yeah,
it's not something they're talking about, but why not? If it's successful here, it generally works in Asia and New Zealand.
Plenty of opportunity ahead.
So one more question before we end. I know we normally finish on what does the long-term vision look like, but a couple of times we've talked about re-rating of the stock. It's an oil company, and oil was on the nose, and then I feel last year there was a big anti-ASG push and oil stocks seem to outperform. But is the reason that the market has derated it compared to its peers and compared to the market average because it's in a sector that's a bit unloved at the moment? Is that yeah.
So I definitely agree, and I still think people associate Viva with the old Viva, if that makes sense. So the old Viva was dominated by a refining division that would be profitable 1 year and loss-making the next. Now, we know that the worst case scenario is $100 million of EBITDA or earnings, give or take. So for me, I think it's going to take, I know this might sound silly, but it'll take for that business to lose a heap of money, and then for the government to kick in, and it goes back to $100 million of earnings, and everyone goes, oh, okay, geez, what do I value that $100 million of earnings on? I think it's a little bit more than I used to value the refining division, because that's underwritten by the government. It's like an infrastructure asset. Yeah. So I think that for me is probably the key. That'll be the turning point for the company, because at the moment, last year and this year to a certain extent, refining margins coming out of Asia, which dictate the market, have been very high because there's been a shortage of effectively refined crude, let's call it crude oil globally. And so Viva and Ampol have been over-earning in that space. And that's a big reason why the shares are trading cheaply, because people think those earnings are too high and will come back at some point. Okay. Yeah. So for me, I think it's when they come back and then the market realize, well, they haven't gone back as far as we thought, that will be a positive for the stock. And then broadly speaking, over the next 5 years, if they're successful in retail and rolling it out and the commercial business does what it's going to do, suddenly you build a case in 5 years' time that the refining division goes from 35% of earnings to 10 to 15% of earnings. And so it's not as important to the business as it used to be. So that mix change is what really should, over time, get that valuation higher.
Yeah. Fascinating. Well, it's a company we'll be watching. Sounds like it's a company we'll be frequenting more and more as we fill up our cars. So we'll walk in and we'll assess, is this thesis playing out?
Exactly.
Thanks for your time.
No, thanks guys. Appreciate it.
Love it.
Cheers.